Are you stuck on where you should get started for investing? Maybe 2021 is the year that you should get invested. As the new year approaches, a lot of people have different goals, and maybe money goals are your goals for 2021. So in this video, I'm going to be giving you 4 questions that you should answer before you start investing, and a 5th question to determine what brokerage you should start investing with today. What's going on, you guys? My name is Danielle, and here on this channel, we talk about stock market investing. And today's video is geared towards beginners, as well as those of you who maybe lost your way in 2020 and started buying a whole bunch of different stocks, and now you look at your portfolio thinking, this is a mess. So here are some questions that you should ask yourself and how you should restructure your portfolio or start one from scratch. Before I dive into this video, I have links in the description down below for a Discord chat that I have. This is where you can reach me and also fellow members of this community for free. So you can sign up today. And if you also want real-time buy and sell alerts for my portfolios in both Questrade and Wealthsimple Trade, you can check out my Patreon page there. For my Questrade portfolio, which is a private portfolio, it's valued at over $200,000, and I'll be showing you all my moves that I make here on out. The first question is, how long do you have in the market? And this question has to be answered individually by each investor for him or herself. For myself, my time in the market is probably about 30 to 40 years because I'm hoping to use this money for retirement one day. But some of you might be in a different boat where you're thinking, I need to be buying a house or an apartment in the next 3 to 4 years, or maybe I'm looking to buy a new car in the next 6 months. So these are some realistic timelines that people have for how long they can be invested in the market. And typically, the longer that you have in the market, the less risk that you have of actually losing out on your investments. So I would say that if you have a longer time in the market, you can tend to take on a little bit more risk. However, if you have a shorter time in the market or a very short time in the market, then consider taking on a lot less risk. And for those of you thinking right now, I only got 5 to 6 months in the market, honestly, I would consider looking into a high interest savings account because 5 to 6 months, anything could happen in the market. We could have another big crash like we did in March, or the market could continue marching upwards. The next question I would ask you guys is, how much time do you want to spend researching? If you absolutely hate stock market investing and just want everything done on autopilot, then consider investing into an ETF and dollar cost averaging into that. And what dollar cost averaging is basically putting in money in certain time intervals, like once a month or once a week, and buying the exact same ETF. So for example, you could go out there and buy this ETF called VFV if you're in Canada, and this mirrors the S&P 500. So essentially, you're owning the top 500 companies in the stock market right now, and you're buying into them every single month or every single week. So you'll catch all the dips as well as all the high points, but overall, in the end, you should come out with around a 7 to 10% return if the market returns stay true for the next 10 to 20 years. If you guys want to spend a couple hours a month doing research in the stock market, then I would say maybe put about 75% of your portfolio in ETFs and the rest of the 25% into individual stocks. Here at least you get some exposure into individual stocks. However, you don't have complete exposure, which limits your risk. And if you can allocate this 25% of your portfolio towards 2 to 5 stocks, then that would give you plenty enough research for each month. Maybe even only considering 1 or 2 is the best idea because it does take quite a while to research into companies. And if you guys are like me right now and you love stock market investing and just want to research every single day, then consider putting most of your portfolio, if not all of it, into individual stocks. And with this strategy, you're going to be sinking a lot of time into researching companies. However, you'll have a better idea and be more well-informed as an investor when you buy into things, and hopefully you can end up beating the market, if not today, then next year or the year after that. For me, the most valuable lessons are typically when I actually lose money, because I typically have a thesis about a certain company, buy into it, and if I'm wrong, then I go back and readjust my strategy and realize the mistakes that I made. If you want to follow my journey and all the successes as well as failures and see these in real time, consider subscribing to my Patreon. Links are in the description down below. I'll give you all my real-time buy and sell alerts as well as reasons for why I'm buying and selling. And each time I'll talk about what went right and what went wrong and why I'm buying or why I'm selling. The last question to ask yourself right now is, what's your risk tolerance? So if you're a high-risk investor, maybe look into high growth stocks or even penny stocks. If you're a medium risk investor, look into a combination of dividends, maybe some bonds, as well as some growth stocks. And if you're a low risk investor, then I would consider looking into ETFs high interest savings accounts, as well as some dividend growth stocks. If all that jargon just went over your head, let me explain to you guys each one of these investment vehicles. First off, high interest savings accounts basically give you a guaranteed amount of interest on the amount that you deposit. For ETFs, they're essentially a collection of stocks that you buy by purchasing a single stock, which is really called an ETF. And this limits a lot of your risk because you're spreading your money across multiple different companies, and the likelihood of all of those companies failing is a lot lower than if you were to buy a single one of them. Dividend stocks or dividend growth stocks, these companies are companies that actually pay out money to their investors quarterly or monthly or even yearly. So these are a lot safer because they're more stable companies that have the cash flow to be able to pay out some of this to their investors instead of retaining it all for growth in the company. These companies are also typically profitable, meaning that every dollar that they spend, they're bringing back more than $1 into the company. As for growth stocks, these stocks typically are unprofitable and they're taking all the money that they can get either from investors by raising capital or from their operating activities and reinvesting it back into the business. So it's very unclear whether the business can actually eventually turn a profit. However, their growth in terms of the revenue quarter over quarter or year over year is quite impressive. Some of these companies are growing their revenues by about 50 to 100%, meaning that one year they make about $100 million and the next year they could be making $200 million. And lastly, penny stocks are typically companies that are very small with extremely high risk. A lot of these companies aren't even making any money right now, and if they are making money, they're losing a lot more money than they're actually making. However, what makes penny stocks attractive is the fact that they're very small, and that if you can get in early and the company ends up growing to be the size of like an Apple or an Amazon, then you could possibly like 1,000x your money in the span of 5 to 10 years. However, note that there's a lot of risk with this, so I definitely don't recommend beginners dabbling in penny stocks. Now that you've established how much time you're able to leave your money in the market, how much time you can devote to actually learning about the stock market, and what your risk tolerance is, you can kind of figure out what kind of investments you want to make. For example, if you have not much time in the market, you have no time for actually researching the market, and you have low risk, then I would suggest buying into things like ETFs like the S&P 500. Now, if you're a high risk investor, love doing research, as well as have a lot of time in the market, then you might be dabbling into growth stocks or even penny stocks, with a combination of some dividend stocks for the mix. With this high level understanding of what types of stocks you're looking for, and now it comes down to the fourth question, which is, what are you an expert in? So one of the greatest investors alive is Warren Buffett, and he tends to invest in things that he can actually understand. So for example, if you're a truck driver, your expertise is in trucks, or just truck driving logistics, and maybe you're looking to invest in the next EV company. You might be looking at Tesla, Nikola, and Hyliion. And I got this information by watching a truck driver's perspective on Hyliion, and it gave me a new perspective on the company. Basically, he said that on the roads right now, there's a lot of infrastructure that's actually set up for renewable gas. However, there's no infrastructure set up for electric charging for trucks. Another thing that's important to note about the trucking industry is that truckers actually abuse their trucks quite a bit. So if you look at current superchargers out there, they're quite small, and I expect the electric trucks charging station to be also relatively small as well. And I think that this could be hit by a lot of truck drivers, and it takes quite a while to actually refuel. So there's going to be a lot of infrastructure need to build out for the electric trucks. However, renewable gas is fairly easy to fill up, as well as the infrastructure is already there. And the fact that these renewable gas stations are quite large means that the chances of a truck driver actually hitting the whole infrastructure is a lot less. So for a truck driver, it totally makes sense for them to be investing in what they know. And maybe for you, you're a teacher, or maybe you're a doctor, or maybe you're an engineer like me. Look at companies that you understand out there and can reason why the company is better off in the future than it is today. At the end of the day, in the stock market, it's just people buying and selling stocks. So the seller always has a reason for selling, and the buyer has a reason for buying. And only time will tell for who was actually right about the decision. Ultimately, the market will dictate who is right or who is wrong. So by investing in things that you actually understand and can have a clear picture as to what the industry might look like in 3 to 5 years, then you're typically going to do better in these investments versus investments that you have no idea what you're doing in. Now you go out there, look for brands that you already know, see if they're public companies, or maybe try to find brands through Google searching or YouTube searching. Once you found your companies, the next thing you have to ask yourself is, where are you going to buy these stocks? So essentially this question is, what brokerage are you going to actually use to buy stocks on? And there are a couple different brokerages out here in Canada that you can choose from. you have either no commission fee brokerages or low commission fee brokerages. The only no commission fee brokerage is Wealthsimple Trade. And that's a platform that I love using and actually show my portfolio on this channel. So if you're interested in that, subscribe to my channel right now. But on Wealthsimple Trade, the functionality is a lot more limited. You also get delayed quotes, so you don't actually know the exact price you're paying because the price on the screen is delayed by 15 minutes and it could have moved in that time span. But the advantage of Wealthsimple Trade is that you don't have to pay any sort of commission fees. So if you're investing small amounts of money, let's say a couple $100s at a time, then Wealthsimple Trade is definitely the platform you should consider. Now, if you're investing a little more than that or doing a lot more tighter trades, then consider going with a brokerage like Questrade, Interactive Brokers, or even TD. These platforms offer you a lot more information. They let you see the real-time price of the stock right now, and you can place different types of orders and strategies out there. Although there's a fee for investing on these platforms, you do get a lot more support from actual support people versus having to email in on Wealthsimple Trade. In addition to this, you also get more information on your dashboard and can track your activity a lot easier than Wealthsimple Trade. For any of these brokerages, you can check the description down below, and if you sign up today, you can get some free money for doing so. Now that you've gone through all the basic questions of where to get started for investing, go forth and prosper. Anyways, that's all I have for you guys today. If you're interested in more stock market related material, like different stocks that I'm buying or selling, or different stocks in my portfolio, click in these videos right up here. If you're there, I'll see you there. If not, keep up the grind and have a great day.